Well, welcome to Credit Outlook. But I think as many of you know, when we talk credit, credit drives all financial markets. It is the underpinning of equity markets. It is the underpinning of derivative markets. It is the underpinning of commodity markets in many ways. So when we talk credit, we're really talking about all financial markets. And we have, a great panel today of people that are extremely experienced in credit and investing. Collectively, they manage about $500 billion. All have had great performance records, and each of them, at one time in their career, have worked for what now would be a bank. It might not have been a bank when they worked for it, but today it is a bank. And one of the areas we're going to cover are the opportunities for investors due to many of the restrictions on the banks today and their flexibility, what they can invest in. But before that, every one of us wishes that we have the talent to execute our ideas. And we'd like to get better performance. We'd like to be able to operate in different markets. But do we have the talent to go into that market? And one of the sad parts of investing is many people choose to invest directly in areas they do not have expertise in. Today, we have 5 people on this panel that have vast expertise. And I thought we'd start in a little different way, going across on the panel here and talk about what is the built-in expertise at your firm, how did you create it, and why don't we start with yourself, Rich?
Sure, Mike. Rich Byrne. I'm the president of Benefit Street Partners, which is an affiliate of Providence Equity. We have about 110 people. Our firm is about 7.5 years old. We run numerous strategies. I guess you'd all call them credit alternatives. Anything from middle market lending to distress to long-short credit to CLOs to our one non-corporate credit business, which is commercial real estate debt. As I said, we have about 110 people. We've sort of built them from the bottom up. A lot of them are former bankers or investment bankers in some way, shape, or form. I'd like to think we've gotten best-in-class opportunities to add people over time. And I'm sure we'll get to it as we go through the panel, but that human capital is sort of the secret sauce, I'm guessing, for all of us, because these are extremely labor-intensive businesses.
So, Rich, you ran Deutsche Bank here in the United States previously. But one of the things I think the audience is not aware of is your expertise as a martial arts. Okay, now, and I understand you have your own gym that you've opened now.
That is
so
right,
with
Mike.
You and Scott on my right, I feel really protected here today. Tell us just shortly, how does that play into your life, your lifestyle?
Mike, this was not in the pre-panel discussion. I'm a practitioner of Brazilian Jiu-Jitsu. I do own a gym, and it's what I do after work and sometimes during to get my stress out. So we'll say it that way.
And the name of the gym, in case anyone wants to come?
We'll make sure we put it on the global website, but it's Mushin, Mixed Martial Arts.
Thank you.
MUSHINNYC.com.
So, Scott, talk a little bit about the team that you've assembled over the years.
Well, Mike, we grew from a firm that had like $8 billion in assets into a firm of about $250 billion.
That's what the global conference does for you, right?
That's right. you become the underwriter here and your assets take off. But, our team today is about 275 investment professionals, and it spans from corporate credit to structured credit to infrastructure investing, public finance, equities, and virtually anything that investors would normally look for. I think the great challenge we have today, Mike, in this low yield world is trying to find opportunities. And one of the things that I find with investors often is that without the appropriate scale and expertise, it's really hard because at times There are times to avoid asset classes, and there are times to be aggressive in asset classes, and I'm sure you would agree with that, Richard. And it's having a big organization and a very talented staff is a great way to be able to be flexible and move around.
So Joseph, talk to us a little bit about Golden Tree and kind of the team that you have there.
Sure. Thank you. Thank you, everyone. Good afternoon. My name is Joe Nagar. I'm a senior portfolio manager and a partner at Golden Tree. My responsibilities include structured products investments. I'm also on the executive committee and also chair our risk and macro committee. At Golden Tree, we're an asset manager. We cover global credit markets, offices in New York, London, and Singapore. We, I think, been founded since 2000, serving our clients for 16 years, with a wholly owned partnership with 26 partners and over 200 people. I think that that's really a lot of where our secret sauce is. The partnership approach is one where we're all encouraged to work as teams. A lot of opportunities that we see tend to fit in a few different categories. So being able to invest in credit, but also being able to bring different parts to the table, whether it be structured products or financials or distressed, is really kind of what we think can make a big difference. Having broad capabilities, you ask about kind of the what makes it work. It's really about setting the incentive structure up properly. And when I look at our process over the past decade and since 2000, it's driven on value. But having the team get together around what the situation is just as important.
Thank you, Joseph. David, you've had significant success in many what might have been esoteric areas of the fixed income credit markets over the years. Tell us a little bit about your team.
Sure. So we run about $4.5 billion of capital. So we're the nimble group up on this stage. We do it with 25 investment professionals. When you're running a team of modest size, I have strong views on this that you need to have both domain experts, people who have spent most of their career in property or energy or high yield debt, and also people who have spanned in their career and looked at a lot of different types of credit. And if you marry up those types of people together, we find that you can both look at rhymes and repeats from the past, but then there's certain things that you simply have to have domain experts to really dig into and do in special situations credit.
Thank you, David. Jim, talk to us about your team.
Thank you, Mike. Well, I'm the managing partner and the CIO of the Apollo credit platform. Many of you, Apollo today is about 170 billion, and we have a long history in the private equity business. But of our business today, about 40 billion in private equity, and the remainder in credit and real estate. Certainly we come into private equity with a credit mentality, and also a bit of probably a cynical value orientation, and that really is embedded in our credit business. Whether it is corporate credit, structured credit, or a variety of the other activities we do around the insurance space, it really is one that's driven by the principal value mentality and really understanding how we think about the short term, but also really three metrics: valuation, fundamentals, and technicals, and trying to get a connection point between all three. But human capital really is the essence of what we do, and certainly the time we spend not only making investments, but really trying to find those diamonds in the rough in terms of individuals that fit part of our team. And certainly we don't identify people by purely a vehicle. It's really an expertise, whether it is in performing credit, distressed, or structured credit. So from our perspective, Mike, it's the essential human element. We like to train people right out of college and have a long career with us. So our retention focus is a great impact. But certainly as we transition, the combination of what's going on in the individual funds and the overall credit markets, as you said, is critically important.
So I think what we'd like to do is kind of give you a brief overview of each of these five individuals' kind of views of credit markets. Rich, why don't you start us out?
Okay, Mike. Specifically, credit gives a lot of opportunities right now. I think as you define the universe that each of us cover and our firms cover, and you've heard the descriptions, it covers a lot of ground. And we were talking backstage a bit about, and all being former bankers, a lot of the opportunity for a lot of the assets that we run has come from a lot of the activities that were run under the businesses of the banks, in many cases the banks that we worked at. And in a lot of cases, I think you'd say that most of the panelists here have probably trained their entire careers for this day and this opportunity. Now, you can talk specifically in a whole bunch of ways. A lot of this ground has been covered in other panels, but whether it's Dodd-Frank, more specifically the Volcker Rule, or Basel, or the Fed OCC guidelines on leveraged lending, or even risk retention rules and CLOs, there's been all sorts of opportunities created in the markets. I'd put them into two giant categories. One is liquidity, or lack thereof in the markets, the lack of a clear market-making function to do the price discovery, where it was never great in the leveraged finance markets, as all of us with a history know. But when the size of the market has more than doubled since the crisis, and the size of bank and dealer inventories has halved, that's a recipe for disaster. So when things are sort of quiet, liquidity seems fine, but when we get spikes, like we've gotten, a massive V of a correction occurred, between July to February, and now February to now, those are being magnified. They create opportunities. I'm not saying volatility is a good thing, but it certainly is a good thing for a credit manager that looks to exploit idiosyncratic opportunities within credits, particularly as when the markets overshoot one way or the other. And then the other, I'm sure we'll go into greater detail later, is there are absolute businesses that are completely off banks' balance sheets in places where we've cut our teeth, again, for our entire careers. One good example is middle market lending. Several of us have middle market lending platforms. This was almost the sole purview of banks, but in this case, because of more Basel regulations than anything else, it's just not an activity that big banks do anymore.
Rich, let's pull up your slide 4. What are these default signals that you focus on?
So this chart, we sort of inserted the years in between as the superficial version of sort of what's happening in the market right now. Think of the confluence of events. This chart, every 7 or 8 years, we get a spike. It's just reality. And a lot of these spikes have been systemic. 2008, the global financial crisis. 2010 time frame was the dot-com bubble. We've had the S&L crisis, the Russian crisis, you name it. They sort of come every 7 years. And right on time came this commodity supercycle with energy. So, I think the simple way to summarize the world is about $250 billion of capital was lost in the decline of oil across credit, from $100 a barrel to whatever, something below 50. And there's your answer to the credit cycle. I think the answer, I'm sure we'll go into this panel, is far more nuanced. Because I would argue there aren't the same systemic implications in energy as there are with some of these other crises we've had before. In fact, there's been a lot of literature written about how lower energy prices is a good thing for many other industries. And I think there are much more important factors to focus on. I'll let some of the other panelists have a crack at some of this, but one is the excesses that have occurred since the crisis, or underwriting standards, to put a broader label on it. Another is the economy, what kind of headwinds are we dealing with and are going to deal with? And then most importantly, the last point I made is liquidity. And the vibrancy of the market itself to refinance its way out of problems.
Thank you, Rich. Scott, what do financial markets and credit markets look like to you?
Well, Mike, to follow on to Rich's chart, slide 62, shows us where we sit today in terms of the total non-financial corporate debt to GDP. And these are levels that are usually associated with recession. But when you consider that U.S. non-financial corporate interest payments as a part of a percent of GDP is only 26% today versus 54% prior to the financial crisis, it would tell us that we're probably going to run long in the tooth with this expansion in credit. And
Scott, I just want to emphasize how important that point is. You know, when we talk about debt, it's really not debt that's the issue. And as Scott has just mentioned, it's the level of interest payments or obligation. So when the middle class or lower middle class or even the upper middle class is going to go buy a car or make a house payment, they're not necessarily focused on the cost of the car. It's what is the question, what is the monthly cost? And many of us remember when interest rates for mortgages hit 18%, well, today at 3%. 6 times the debt cost you the same amount of interest. And I think it's really important, this point, I just want to emphasize the point Scott made, this historical looking at debt as measures of GDP or something might not be an accurate thing to do versus looking at what the interest payments are. And as many of you are aware, Unilever borrowed recently at 0. So how much debt are you willing to put on your books at 0? If you're in Japan, you have to figure out how you're going to get a positive rate of return. But in most other parts of the world, that's the opportunity. So
Right.
let's go back to you, Scott.
well, and the slide we just had up, Mike, if we can pull that up again, you know, it shows that this central bank policy around the world, which has kept borrowing costs very low, you know, is showing no sign of ending. And you know, it's interesting. I'm an advisor to the Federal Reserve in New York, and one of the discussions that we continue to talk about is how fast can the Fed increase interest rates?
I think your slide 63, Scott, if you really emphasizes, maybe you could talk about that.
Right. Well, I mean, basically, when you look at interest payments as a percent of the estimated cash flow, it's very low compared to where it's been historically. But you know, at the same time, U.S. corporate default rates, you know, have spiked historically. But if you look at periods like the financial crisis, we had a lead up, an increase in the interest payments as a part of normal cash flow. We haven't seen that increase that would presage a financial crisis. And so, you know, I think given monetary policy around the world, we're going to continue to have this sort of inflated bubble of credit probably for another 2 to 3 years, which I think, Mike, is an important factor to consider when you're looking at an investment horizon where we might be facing a recession in another 2 to 3 years.
Mike,
Well,
if I could just add, though, Mike, on that comment about the bubble. I mean, I think certainly if one thinks about the 10 trillion of central bank activity, what that has done, it's forced investors to go out the risk curve. And if you look at equity returns the last 7 or 8 years, I would argue that it's brought 20 years or 15 years of equity returns into 5. And therefore, if one looks at the next horizon of the next 3 to 5 years, certainly we're going to get credit cycles. And as we sit here in early May, very few of us would tell you there's credit alpha today in the market. There was 8 weeks ago, there isn't today. But the bigger picture, the environment that we've all come from, coming from banks, those banks have a different footprint today. And there's 3 ways you make money in our business. You can make it in alpha, outperforming the index, the beta, or just having a better mousetrap. And you know, what we're doing at Apollo and some of my peers are doing here is, you know, creating vehicles, creating entities that it's not only it's matching up human capital with great long-term assets that aren't faced with the vagaries of business. So, you know, we have a business, Midcap Financial. It's a middle market lending business. And if you go to slide 23, you can see in the last 4 or 5 years, this business has grown dramatically. Last year when GE wanted to parcel out and get away from being an industrial to being a industrial corporate, we were able to buy $3 billion of assets. And if you go to slide 24, you can see how not only the balance sheet has grown, but the look at the diversification across the business. Used to be a healthcare business, and now it's a much broader leverage lender. So the point that I want to make is with the secular re-regulation, with the secular deleveraging of financial institutions, along with this central bank policy, credit is going to be the place for investors to add yield to their return to their portfolio. You obviously have to be thoughtful about when you enter it week to week or month to month, but it's an incredibly interesting time when we think about the world having $9 trillion of debt that yields negative rates right now. Credit's the one place where you can actually make some money.
Joe?
Yeah, so I mean, echo a couple things, but maybe at risk of getting some jujitsu applied to me by Richard, maybe disagree a little bit on liquidity. There's a couple things I want to talk about. I mean, liquidity, and we can talk about perspective of it. If you turn to slide 10, let's just talk about high yield, the high yield bond market. In the last, few weeks in this year, you can see on this slide that we're talking about 8 to 10 billion a day of trading activity. And so that's actually quite a bit. And if you look at it, it's actually been growing versus the long-term historic average. But the next question, of course, is then, well, what about the size of the high yield market and what percentage? And if you turn to the next slide, you'll see here that as a percentage of the outstanding, it's actually rising. And in fact, actually, we're annualizing maybe close to over 2 trillion of trading activity in high yield. So what's giving here? Why is there this feeling of less liquidity? Well, from the dealer's perspective, and this is on the bank side, it has changed, and dealer liquidity is different. But the overall broad market and the amount of buyers that we're looking at that are participating in the credit markets as a total is much bigger than it has been historically. So while the dealer side has been coming down and maybe instantaneous liquidity, and if that could be characterized maybe by a dealer making a $100 million market on the wire or some large amount on a liquid issue, that maybe has changed. But what we see on our side is that it actually exists in a good way. Distressed credit can be different, and those are situational. But the broader market for credit, liquidity is important. It's something we spend a lot of time thinking about, and we think it's actually pretty decent. Could it be better if dealers were there? Yes.
But it's interesting, Joe, is we've done work that shows that the average premium on a high yield bond today is about 150 basis points higher than it was pre-crisis. And it seems like this added liquidity premium, I wouldn't argue with the trading statistics, but I think the bid-offer spreads are further apart. And this liquidity premium actually can accrue to the benefit of investors.
I think the issue is when you want to change your position, you want to be doing it at a time when other people want to buy your position. When Jim said a minute ago, you were talking about equity markets probably discounting too much, and then you talked about no credit alpha. I actually thought you were going to say no credit beta, because I think if you look at the underlying building blocks that we use for credit, property markets and the high yield markets, there really isn't much of a beta story. But I wanted to look at slide 17, just to show how much alpha still might be remaining in the high yield market. So we've taken a couple of snapshots. On the left here, you see what the high yield market looked like in 2014. And you can see it was $1.3 trillion, biggest ever. And more than 10% of it wasn't even high yield. It was trading at less than 200 basis points spread. And the vast, vast majority of it was trading between 2 and 5% spread. And almost none of it was what we would call special situations credit down at the bottom, which is that 31 billion. If you flash forward to today, and this is a month old, and things have changed a lot, but you can see that $31 billion bucket, it got 7 times bigger. Now it's actually changed. It's reduced from 200 billion at the end of March to 150 billion at the end of April. So there really was a rally, and high yield markets in terms of beta, they're up 7.3% this year. So I don't think there's a lot of beta left in high yield. I wouldn't want to be long the beta. But there's still 150 billion of special situations credit trading at north of 10% spreads. That is quite interesting. Now, the next question I usually get is, well, isn't that all energy, metals, and mining? And if you flip to page 18, nope. At 18, you'll see on the left-hand side, what we've done is color-coded this. It's a little hard to read, but in blue, you have energy, metals, and mining, which is about 48%. There are plenty of stressed credits that have nothing to do with the most depressed industries, and we've listed some of those on the right-hand side if you can read them, and there's plenty of special situations credit where there is credit alpha, where there are opportunities, where debt is not going to stay at 1,500 over or 2,000 over or 1,000 over. Some is going to get worse in default, some is going to get better and compress towards more normalized high yield. But this is why there still is a credit alpha opportunity in our view in the markets.
Yeah, David, totally agree. I think maybe building on your slide, if you turn to slide 9, you'll see on one of the things that we see as a theme are fallen angels. And this is where maybe liquidity can be kind of interesting because you have transition from an investment grade buyer to a high yield buyer. This year, we've already had 85 billion worth of fallen angels come into the market, and that's coming into the high yield market. It's almost like a new issue.
So I think, Joe, what we used to, talk about it is nowhere to go but down. So when you've bought an investment grade security, let's go back to that slide if we could, and you see that it's yielding little spread, and you can see the movement over the years, where the movement of things that used to be investment grade get downgraded. And so at one point, the coal industry, everything was investment grade, and we might end up in a situation where they're all in default. So as you're making these investments, it's extremely important that you understand where the future of that industry is going.
Yeah, and even you bring up coal. Back to kind of maybe specifics, there's a coal dip that we were recently involved with, and this actually touches the banks. Banks historically probably would have been much more involved in a dip facility. And in a recent situation we were involved with, in a club deal, we were able to provide a dip financing with very attractive mid-teens type yields at a 25% LTV, cash covered, very attractive. So there is sort of a lot of alpha, we think, and some of it is driven by the stress we're seeing in the commodity, energy, and sort of metals and mining area. But broader, there's situations across the globe that we're seeing that are very interesting.
So I want to paraphrase, if I could, a couple things we've covered here. One, Joe has put forth this concept that the explosion of institutional investors, tens of thousands potentially around the world, whereas the inventory and the dealers willing to take on inventory has dropped consistently. And when I often look at inventories, we carried more inventory than everyone today carries in $86 from that standpoint. So the inventories of the restrictions have gone down, but the explosion of institutional buyers has allowed trading to continue. And Scott's point is, yes, there's been continued trading, but the spreads have opened up in the transactions. And David's comment is, well, the time to sell is when everyone wants to buy, and the time to buy is when everyone wants to sell. And I want to go really to another area here. When you listen to credit allocations or asset allocations of large institutional investors, they often say we have so much for debt, so much for equity. Yet the life cycle of a security runs from debt to equity. So yes, at 100 cents on the dollar, a bond might be a triple C. But at 70, it might be a triple B. And at 30, it might be a triple A. And so we don't adjust the ratings based on where the debt is trading. And at 20, it might be stock. And so one of the ways to look at the marketplace is you might be buying to buy equity by buying debt and buying ownership from that standpoint. And one of the things that I want to talk to the panel, this panel is not dependent on what the rate for a triple B or a single A or a double A or even a double B bond is today. Because if the average actuarial assumption is 7, you're not going to get it in any of those categories. Yet they're focused on generating substantial rates of return by looking at derivatives of credit. So Rich, why don't we just go down the line quickly here?
Sure.
Talk about the markets that you're looking at.
So maybe we can pull up slide 3. I feel like this panel is turning into the battle of the slides. So here's another take on a lot of what's been talked about. Maybe this is just an easy way. Let me just focus you on what you're looking at. This is by rating category, and I'm not an advocate that the rating agencies always get it right on an individual credit name basis, but directionally certainly correct over time and over an index. Triple C's versus single B's, double B's, triple B's. Look at the dispersion difference. This chart doesn't go out far enough to see sort of where we have been, but since 2011, it's been virtually flat. You know, the index was trading at 5 to 6%, depending on the month you're talking about. Now, you know, we're at 8. The spread between triple C's and double B's is expressed on the right side of the chart. So, I mean, let's take this as a backdrop. The market did a V, as we talked about it, massively corrected, and then we've been in a rally ever since. And where things have landed are still about 150 basis points cheaper to where it all started in July, and I'm not sure a lot has changed between now and July. So this a lot has to do with the volatility we're speaking of. So where is the opportunity? I'd argue it might be in every one of those ratings categories, but people say the correction was because of energy. Well, not every one of those CCC names is energy. In fact, most of them aren't. At the peak, that was almost 20%. And if you take out energy, it's only a couple of hundred basis points tighter. So there's been a lot of gems, a lot of good credits that have been probably punished unnecessarily, and vice versa, maybe some not so good companies that have been given the benefit of the doubt. This is where, and in that CCC line, you know, you're earning 16%. If you just buy it, you're pulled to par, and you know, you sell it and everything goes well at the end. There are ways to leverage that through, I think Mike's question was going, is there's a lot of other ways to express bets. One is through a long-short strategy, which we do, as well as through you know, CLOs, where I'll leave it to some of my colleagues here, but a way to build a portfolio and then tranche it out.
Thank you, Rich. Scott?
Yeah, slide 70, since this is the battle of the slides here. What's interesting about this chart, Mike, is that it's basically showing us that the derivative of credit is actually paying you a higher return than the credits themselves. And for instance, if you look at AA corporate bonds here and then compare them to AA CMBS or to agency MBS or to AA CLOs, you can find that you're actually getting higher returns in structured credit at comparable credit risks. And then when you go up to something like a BB CLO, and if we had a single B CLO on here, you'd see it was yielding 14 to 16%. You can find that a derivative of the high yield market is actually paying you a substantially higher return. On the slide we just looked at, BB corporate bonds, I think we're trading somewhere around 6%, give or take. And yet you can look at a BB structured credit that's giving you 12 to 14%. And you know, we can argue about whether the quality of this structured credit is as good as the quality of a BB corporate bond. And you know, to be honest, I feel like that's what you pay us to do when you're a client. We do the work to determine what is the real risk in that BB bond. But what's interesting to me, Mike, if we were sitting here 20 years ago, structured credit would be a sideshow. Today, when you look at the CLO market, it's over $1 trillion. You look at the CMBS market, it's over $1 trillion. These markets are overtaking the traditional markets in size, and I think in the future will be even larger than the basic corporate debt market.
And I think if we threw in the derivative, so what we're talking about here, David, I want to go to you, and Jim, you want? Well, I really want to stress is that the opportunities in buying these traditional securities pale in the opportunities to look at structure. And as Scott has pointed out, we're talking about trillion-dollar markets, but you need to have a team in place. Jim?
Well, the point, you know, tying back to your first comment, Mike, you know, this is about active management. And I know in the equity market, there's a great push to passive management. Credit is all about active management. It's human capital, and whether it's in CLO liabilities or the activities that one does to really deep dive into the actual underlying credits and then overlaying structure to that, it's critically important. And, you know, it's ironic in the last 6-8 weeks, you know, the ETFs and loans and bonds, the assets in those are up 35, 40%. And a lot of institutional investors say to me, well, the transaction cost is very thin for me to get in and out. And I say, well, that's correct, but you missed, the big mistake you make is the friction cost of getting in and out of the market, that liquidity that Joseph talked about. They're coming in, you know, on the offered side, they're selling on the bid side. So those are always going to have tracking errors to the marketplace. So the ability for active managers who really understand these vehicles, have the expertise, we're going to constantly outperform. And tell you have a great example. 90% of high yield managers that are focusing on the benchmark, they're underperforming year to date. And I guarantee you most active managers are doing this, the converse of that, and outperforming.
And Jim, I might, if you can generate 30% from me in a couple of months, I'm willing to take some transaction cost. Yeah. David?
Yes. So I mentioned before what the raw building blocks are, and I wanted to touch on property, specifically commercial real estate. So commercial real estate in the U.S. is clearly in late cycle. We've had huge price appreciation of commercial real estate from the crisis, and we're at higher prices. So we don't think commercial real estate in the States is, from an equity side, is particularly attractive. There are certain other countries in the world where it is more attractive. The slide that Larry anticipated here is, remember the wall of maturities we were supposed to have in corporate credit in 2014 and then again in 2017? It didn't happen. It got extended out. It is live and real in commercial MBS. So you had commercial MBS got humongous in 2005, 2006, 2007, and while many of those loans have paid off and some have defaulted, this year and next, you can see we have north of $100 billion each year of loans to deal with. So what's making it very interesting from a catalyst perspective is there are bonds that you can buy at 5 cents on the dollar, at 80 cents on the dollar, and any price in between. Ours tend to average about 50 cents. But we're going to find out in the next 18 months what happens to these loans. And Mike and we were talking about this beforehand. Some of this is equity, some of this is junior debt, some of this is senior debt, and the derivative, meaning the CMBS, you really have to look through to the individual loans. You really have to look through to the individual properties and understand what's going on. But there are large sources of alpha available in the CMBS market from the short-dated maturities. The other thing we talked about is banks are very constrained. If you have a stabilized commercial real estate property, and everything is perfect, Josh mentioned this on the panel yesterday morning, you can get a 4% loan. If there's something wrong with it, banks won't lend. And that is where funds like ours are stepping into the breach. And instead of offering 4% loans, we can offer LIBOR plus 1,400 loans with very short-dated maturities, meaning 12 to 18 months for transitional property. So that's the type of thing. This is a way of playing late-stage real estate with a huge margin of safety.
Thank you, Jim. Joe?
Yeah, you know, structured is definitely an area that we think is ripe for taking advantage of. There's a lot of mispricings. And if you turn to, page 12, one of the things that's kind of, staggering if you want to compare it to the corporate market, pre-crisis and post-crisis, because some of this is, about what's happened since the financial crisis. Before the crisis, there were, in fact, quite a bit more structured finance issued. You'll see on the chart, versus corporates. But then now you turn to post-crisis and you see it's actually a fraction. If you turn to the next slide, what you'll see is there's still really big markets, and this Mike alluded to. One thing I learned backstage was that Mike actually structured the first CLO, and this one, it was amazing, it was in 1971. But the market took off, obviously, and was a brilliant idea. And there are a lot of different nuances to investing in CLOs. And when you look at the plethora, and this is where it takes, Mike mentions systems, technology, people, there's over 1,000 CLOs out there. There's 4 or 5 tranches per deal. There's 100 bank loans in every transaction. There's U.S., there's Europe, and then you got to drill through the portfolios because sometimes you got energy exposure, sometimes you have other risks that you need to take into, but then there's also upside. So in a low interest rate environment, when we're talking about negative rates in maybe 2/3 or 20 to 30% of the sovereign debt market, which is amazing. You'll find that areas like this that are sort of mispriced take some unique skill sets to be able to get access to that capital is interesting. Maybe another one, just a little bit off the beaten path on the derivative side, kind of sort of idea. Something that often we see maybe a little bit more on the emerging market side are the spread relationships between quasi-sovereigns and sovereigns that occasionally become overlooked. One example would be Pemex versus Mexico. Pemex, probably the most important company in all of Mexico, came to market with about $5 billion worth of debt just recently that was priced about 300 over. And that relationship's usually about 100 over. Another area that we've been able to take advantage of that's more specific is a state in Brazil called Minas Gerais. This is the second most populous state in Brazil for soccer players out there, also the home of Pele. Was interesting because that actually trades about 300 over, and it's actually on its way tightening to close to 200, and probably inside of that we expect relative to the Brazil sovereign. So these are areas where we can find some mispriced investments that still yield something in today's environment, but are derivatives of of credit.
I want to pick up on a point that many of our panelists have made. The technology required and the infrastructure required today to go through CLO portfolios, CLO structures, CMBS structures, it requires a significant investment in technology to analyze this. So when you're looking to invest in this, what is the debt that makes up that portfolio? What's the structure of the debt, et cetera? That is public data that you can access, but you have to have the systems in place to address this. And this is a challenge for many institutional investors. Very few of them will spend the money in terms.
Yeah, Mike, I mentioned we had 25 investment professionals. We have 9 quants, and this is what they do all day to augment our investing team: is analyze, rip apart, run scenario analysis. We have computers running overnight, running Monte Carlo analysis on every bond that we own, every structure that we own. It's very important to invest in this type of analytics and technology.
Well, the thing I was going to say, if you want to take advantage of something like the CLOs I was pointing to earlier, we have a staff of 35 credit people that do nothing but analyze loans in the side of those transactions. And on top of it, we have a staff of 20 attorneys which read documents, and a dedicated staff of 10 people that are doing just structuring. So how can an organization that would want to invest in that asset class invest and put all that infrastructure in place? It would just be uneconomical for most companies.
Mike, if I can give even a lower tech answer to that question. We mentioned middle market lending before. This is a business banks we're in now, generally off banks' balance sheets. It's a very labor-intensive business. Think of what banks used to hold as far as human capital to do any kind of lending. We're just talking about the size of company. It's really the same number of people. It's originators, structurers, credit officers, then people to monitor the loans, the systems to do all that stuff. And just, I'll give you some context. So one, where the business migrated to was away from banks and onto non-bank lenders, effectively, private debt funds, mezz funds, senior debt funds, whatever, and BDCs, business development companies, and there's a few folks on the panel that run BDCs. Well, there's 55 public BDCs, 55. And of those 55, by our estimate, only about 15, maybe to be generous, 20 of them, we would consider to have the scale necessary to run a BDC. I'm talking about like 35 people or something to do all those functions. Most of those BDCs would have fewer than that. So, I mean, that just to me argues that there's an incredible labor component to all this. When markets dislocate, like businesses go away from banks, often there's a growth phase. It's a great opportunity for everybody. But ultimately, then there's that industry life cycle where things consolidate to the bigger players. Just like CLO equity, nobody mentioned, but risk retention rules. That's another factor that's just migrating that space to the larger players.
Thank you, Rich. And so what's the summary? All securities aren't traded equal. All business development corps aren't equal. You need to understand what the talent and the personnel is. Jim, I'd like to go to you. You have a very wide range of focus in credit. As you interact with large pension funds, endowments, sovereign wealth funds, and so on, many of them tell you they have so much allocated to a particular area. How do you try to approach them and tell them that you actually have an equity product that might outperform equities, but it's in credit form? And so earlier you pointed out you've had this move in equities that's so significant that maybe we've taken the future rate of return in equities and accelerated its return today. How are you engaging that institutional investor who tells you they only have a 20% allocation to debt when you have such a wide range of products to offer them?
Well, I think, Mike, you're correct. We're confronted with that every single day in many meetings out here. I think first it's the definition of really taking people out of a fixed income mentality and taking them to a credit mentality. So I think many folks look at the treasury screens and they get enamored with either liquidity or perception of liquidity in a in a fixed income cycle. But I do think that a broader swath of investors today realize the challenges of whatever their bogey is, 6, 7, 8%, and there's a greater and greater recognition of the challenge of where returns are going, where returns have been and where they're going. And I think that most investors today are, in my mind, they understand that the ability for a broad array of credit products, 5 years ago we were sitting on this panel, it would be, is it time to invest in high yield? Is it time to invest in distress? And it was a very binary function. And now the array of activities, whether it's structured credit, real estate debt, real estate mezzanine, non-performing loans, they see that if you can generate that type of high single digit, low double digits with lower vol, that there's a core spot in one's portfolio. And I think there's a greater recognition. I do think many institutional investors, though, are challenged with making that first leap. They're concerned about commingled funds. They want to focus on large SMAs. Where a firm like ours is able to handle a variety of those with large commingled and large SMAs. But certainly I think there is a much, much greater realization that if you have something in a mid to high single digits, low double digits, that's very accretive on a risk-adjusted basis to a portfolio. And I'll use European. We have a big business in the European non-performing loan space. It's one where for 5 years, investors have said, well, there's never going to be there's never going to be the proverbial garage sale, and every single month there's a few Italian, Spanish, German banks that sell assets, and when you look at the returns of these vehicles, they're mid-teens net, 1.6, 1.7 MOIC, and it's a much better risk-adjusted return when you put it in an overall portfolio. So I think investors are embracing a wide variety of alpha-driven and mousetrap strategies.
So David, I'd like to just go to you for a second. You showed us the large maturity of CMBS debt. Your firm is prepared to take advantage of this opportunity. How many of the people, David, coming in, the institutional investors, where they're coming in through their real estate allocation versus their credit, where they could buy real estate at a discount if they were coming in through the CMBS?
Very few. Very few seem to be coming in through the real estate allocations. In fact, it seems to scare them a little bit that they have a real estate allocation, and is this going to conflict with what they do in real estate? But it's really quite different. And so you have a pension fund that owns the building in which I work, and it probably owns it at a 3% cap rate, and we can buy them CMBS at 8% return, 12% return, 15% return. And so, but yes, it doesn't seem to come in through the real estate allocation.
But I'll give you a good example. Last week in New York, Mike, one of the iconic properties, the Sony building, got sold. The owner had bought it a few years ago. They were going to do a big development plan. We were the mezzanine investor to that. They went to one of the big banks. They got a sub 200 first lien. We were in the mid eights, LIBOR plus 8 on a very attractive mezzanine piece. Over 2 years, our return was high teens, 1.4 multiple of our capital. We outperformed the equity on that transaction and took a lot less risk. So that's a classic example right now in the real estate space where if you're thoughtful about structuring that senior mezz, the big money center banks, 0 to 50 LTV, they'll compete down to LIBOR 150, 175. Then there's a large gap in that next mezzanine piece, 50 to 60, 50 to 70. And that's where thoughtful investors can go in and take the whole piece on high quality property.
Thank you. And I think this is one of the challenges that exist, and I want to challenge each of the 5 of you in the future. How do you communicate to that institutional person that wants you to manage their money and just not approach their credit allocation, and you're talking about their overall portfolio? How do you give them the freedom to interact with their real estate group, their equity groups, and other allocations in a sense, what you're investing in takes all form. Scott, you probably make more presentations than anyone in the world. And you travel the world. What is your interaction? Who are you speaking to when you're talking to sovereign wealth funds, pension endowment, insurance companies? How are you talking about their asset allocations?
Well, it's interesting, Mike. Most of the time, as you know, when you go in and you talk to these sovereign wealth funds or pension funds or even insurance companies, they will have bucketed up their allocation. There's so much money for infrastructure, there's so much money for private equity, so on and so forth. But interestingly enough, just today, I met with one of the large sovereign wealth funds, and we were talking about infrastructure. And he was definitely very progressive in thinking about transferring between asset classes. The critical thing was the rate of return and the risk. Now, when we get to some of our insurance clients, for instance, in some cases, we've actually had the insurance clients turn over most of their portfolio to us. And there, it's a lot.
I'm sure that broke your heart, right?
If they would only pay a higher fee, Mike, But the interesting thing there is you can actually have a broad discussion about risk and do the trade-off dynamically with the asset classes by having ranges of allocations for an investment committee to approve. But the one thing I will say, Mike, is that when I meet with some pension funds, they find that discussion threatening. There is an institutionalized system or process there, and to have somebody else come in and tell them what their allocation might be, basically in some ways seems to threaten their existence. And so not everybody is as open-minded to hearing those kinds of discussions.
I think one of the challenges, and this is not new, in the early 70s, insurance companies often, the CIO did not want to get into a fight with his equity or his debt. So they decided they could only buy convertible bonds in the new issue. They couldn't sell them. They couldn't buy them in the secondary market because they didn't want to discuss whether they belonged in the debt or the equity portfolio. They let the equity people buy them on the new issue, and that was it. So these are challenges, and many of the CIOs in the audience have this challenge in that someone has decided an allocation between different parts of the structure, whereas the securities bridge them. I know, Joe, your firm for a number of years in the downturn was very focused on annuities, buying annuities. What is an annuity? What asset class is buying an annuity?
Well, in the case you referred to, I think that was AIG GICs at the time, guaranteed investment contracts. That was again sort of your theme on things that aren't just straight credit. Sometimes you can find some mispricings. In today's market, those are priced well. That's not where to go. But in another market, it might be. So when we look at designing funds for our clients, our pension funds, we have over 50% of our clients of our 25 billion are pension funds that are corporate as well as public. We're trying to be a solution provider related to the problem of generating investment return. So when we look at today's low rate environment, it's designing the capability for us to access that part. Typically, it's in their fixed income bucket. But being an alternative to other areas that they might be looking for to get yield, that's what we try to be the provider of. So it's the insurance annuities that you mentioned are an example of a time where you had a dislocation in 08, but we continue to see that effect in a lot of different credits because credit is different in different markets. So that's kind of what we're trying to offer.
But Mike, I would add that the list, I think, to your question though, what we have found, if you put the list of investors up there, many of we're familiar with, most investors have historically tried to put limitations and boundaries. And I have found, or we have found at Apollo, that it's the lack of boundaries that allow you to really be opportunistic and buy that bond at 30 that may be rated CCC, but really is the control equity in the business. So it's a partnership and dialogue with the largest investors. So there's an element of dialogue and trust and they give you that flexibility and those boundaries, because 9 times out of 10, it's the limitations. It's when Encana gets downgraded and Moody's has put it on watch, that's where the opportunistic folks are buying it at 60 and selling it back to the same investors at 90 a month later. So avoid those limitations and have that flexibility is the key to earning money in credit.
I would say some of the onus is also on us. I mean, we have limited control over how our investors are organized. What we can do, though, is make it more clear what our funds' mandates are, how we produce alpha, and our fee structure should be reflective of that as well, meaning if we produce alpha, we should get paid. If we don't produce alpha, we shouldn't. And I think some of that is the onus is really on our industry as well to make the job of everyone else a lot easier.
Mike, maybe in the last second, one area I wanted to kind of, as we're talking here, is just risk management. And that's an area where we have seen a lot of volatility in the markets. There are a lot of risks. And that's something that I think when we spend time trying to address that in today's market, managing downside volatility to us is critical. So where do you go and how do you do it is part of how we design it. Thinking about having tools to manage risk that are outside of credit, because that sometimes is not the most efficient way to hedge. Being able to use sovereign debt, being able to use equities or commodities, running stress tests to understand what your drawdown might be in different environments. Because in February, you want to understand that and you want to be able to put hedges on that can help take care of that downside volatility and protect capital. And quite frankly, let you also go on offense when you might not otherwise. So these are things I think we spend some time on with our clients.
Mike, on this point, sorry to, just on the sovereign wealth point, Jim, to carry on what you were saying, there's actually a very big advantage to being such a large investor. You would think of the negative side of that as the ability to put that size capital to work. One of the real positives is the ability to create separate accounts, and I think this is clearly a direction a lot of the world is heading, because I don't know what credit's going to give us for the next 2, 3, 5, 10, 20 years. I just know that it's going to be a very interesting path. Where are we in the cycle now? I don't know. What structures will we figure out? Will we invent? Sort of which way does this take us? What alternative products? Some of the topics we're talking about here. What we're all trying to do is develop products, mostly in lock-up fund structures in most cases here, that are strategies that will persist for the next few years, 4, 5, 6, 7 years, whatever it is, as long as the fund's life. But the ability to maneuver in and out of that and have maybe as a partnership with the investor and the manager, the ability to toggle, based on where the opportunity, that seems to be the trend of the future.
Thank you. So in wrapping up, I just a couple comments that I think are important that we heard today. A lot of opportunities in structured credit requires significant sophistication to differentiate the products. When we talk credit, we're really talking the entire balance sheet in many ways. We're in the form that you're investing. And I think one of the other elements we have not discussed today is one of the side effects of very low interest rate is the enormous liquidity that exists in corporations today. Trillions and trillions of dollars sitting. And if you just look at where you sit today as a percentage of the GDP versus where you sat in 2006, you have tremendous changes in liquidity in corporations. And we have the first corporation, not in their pension fund, but the first corporation that has a $100 billion bond portfolio. And when you can borrow at 0 or 1 or 2 or 3%, you might want to lock those rates up for a good time, long time, and before you figure out how to deploy your capital. But the liquidity that exists in companies, we're well aware of the sovereign funds, the pensions, the endowments, the 10 trillion sitting in the 3,000 largest family offices. But this increase in corporations and their willingness to come into credit markets in this way is really a change in the markets and should create even more opportunities. Thank you for joining us today. I think we got a good understanding.